If you're an S Corp owner, you already know you're walking a tightrope. On one side, there's this amazing way to save a ton of money on taxes. But on the other, there's the very real risk of a painful IRS audit. So let's dive into how you can get the tax savings without ending up in the IRS's crosshairs. Because getting this balance right, it's absolutely critical.
So here's the question we all need to answer. Is your current pay strategy a smart tax move, or is it basically a giant red flag for the IRS? Because honestly, the line between the two can be way thinner than you think. And the consequences? Well, they're pretty steep.
All right, so here's our game plan for this explainer. We're going to start with the salary dilemma itself, then talk about why the IRS is suddenly paying so much attention. After that, we'll get into the reasonable tests they use, and from there, we'll cover how to build your defense, the high price of guessing, and finally, how to find that S Corp sweet spot.
Okay, let's kick things off with a salary dilemma. At its core, it's really a conflict between the two different ways you as an owner can pull money out of your business.
So check this out. You've got two main options. On one hand, you can pay yourself W-2 wages. The catch? Those are hit with a 15.3% payroll tax for Social Security and Medicare. But on the other hand, you have distributions, which are not. The incentive here is crystal clear. Every single dollar you take as a distribution instead of a salary saves you more than 15 cents. And that adds up incredibly fast. But, an incentive that powerful was bound to get some attention. And that brings us right to Section 2, why the IRS is suddenly watching S Corp owners so closely. The scale of what's happening here is just staggering. The IRS recently flagged over 266,000 S Corp returns, and they all had one thing in common. The owners paid themselves zero in salary, but collectively took out a whopping $69 billion in distributions. To the IRS, that's not just a red flag, it's a full-blown siren. And don't think they're just sitting on this data. The IRS has put real resources behind this, launching what they call a compliance initiative project. Its whole purpose is to ramp up audits on S Corp reasonable compensation. The days of this flying under the radar, they're over. They're actively looking for this. And if you want to know just how seriously the courts take this, you don't need to look any further than this quote. It's from a famous case involving an accountant named David Watson. The court's message was brutal and clear. Pigs get fat, hogs get slaughtered. In other words, trying to get every last penny of tax savings can end up costing you everything. Okay, so we've laid out the problem and the risk. Now, let's pivot to the solution. Section 3 is all about understanding the reasonable test. This is the exact standard the IRS and the courts are going to use to judge your salary. So what in the world is reasonable compensation? Well, at its heart, it's the market value for the actual work you do. The easiest way to think about it is to ask yourself this simple question. If I quit today and walked away, what would my company have to pay a qualified stranger to come in and do everything I do? That number, that's your starting point. The IRS isn't just pulling a number out of thin air. They have a whole list of factors they look at. Things like your training and experience, your actual duties and responsibilities, how much time you're devoting to the business. They'll even look at what similar businesses are paying for similar jobs, how your company is doing financially, and what you're paying your other employees who aren't owners. It's a whole picture, not just one simple formula. And this is a big one. You've probably heard someone mention a 60-40 rule or some other magic ratio for salary versus distributions. Let me be perfectly clear. That is a complete myth. The IRS and the courts do not recognize any percentage-based rule of thumb. Your defense can't be, oh, I followed a ratio. It has to be based on facts. Okay, this brings us to the most important part, what you can actually do. Section 4, building your defense. This is how you create a salary that can stand up to scrutiny. The absolute best way to think about this is that you're wearing two different hats. With your employee hat on, you're performing services. You're doing the work, and you deserve a fair market salary for that labor. But with your investor hat on, you've put capital and risk into this business. You deserve a return on that investment, and that comes in the form of distributions. The whole trick is to pay each of those roles properly and keep them separate. So how do you do it? It's a 4-step process. First, analyze all the different roles you play. Are you the CEO, the lead salesperson, the head of operations? Second, go research the market rates for those jobs in your area. Third, and this is so important, document your reasoning. Write it down. Put it in your corporate minutes. Save your research. And finally, be consistent from year to year, adjusting your salary just like you would for any other key employee. Now, if you're still tempted to just pick a low number and hope for the best, well, Section 5 might make you think again. Let's look at the very high cost of guessing wrong. Let's go back to that David Watson case. Look at these numbers. He paid himself a salary of just $24,000 while taking over $175,000 in distributions. The court said, no way, and reclassified a huge chunk of those distributions as wages. And then they handed him a massive bill for all the unpaid payroll taxes.
And the pain doesn't stop there. When you lose an audit like this, the IRS doesn't just ask for the back taxes. Oh no. They tack on penalties for failing to pay, more penalties for failing to file the right forms, and then they charge you compounding interest on the entire massive bill. It's a financial avalanche that can be absolutely devastating.
But let's end this on a more strategic note, because this isn't just about avoiding disaster, it's about being smart with your finances. Section 6, finding the S Corp sweet spot.
You see, the ultimate goal isn't finding the absolute lowest salary you can legally get away with. The real sweet spot is finding a defensible number that does three things for you at once. First, it keeps the IRS happy. Second, a healthy salary lets you max out your contributions to powerful retirement plans like a 401k. And third, it builds up your earnings history, which means bigger Social Security checks for you in the future.
So, as we wrap up, I want you to think of it this way. Your S Corp salary is so much more than just a number on a tax return. It is a strategic financial decision. It is your first line of defense against an audit, and it's a key building block for your long-term wealth. So the question you really need to ask yourself is this: is yours built to last?